Hi guys, we are from Group 1 with member Amalina Nur Eza, Cita Tasya Nataniela, Denis Vika Amalia, Farliza Atna Ayu, Vivi Dwi Rahma Septianingrum, Kamalia Nur Fauzati, and Mirta Hamidah. Now, we will presenting and discuss about the concept of national income.
Definition of national income. What is national income? National income is all income received by all members of society or all family household in a country for a certain period of time, usually within 1 year. There are three approaches to calculating national income. First, production approach method. Second, income approach method. Third, expenditure approach method. Let's discuss about each method. First, production approach method. Production is an activity that creates added value. In calculating national income using the production approach, only the calculation of added value in each production sector is required. The added value is added up from all sectors during one period. Value added refers to the difference between the production value, output value, and the intermediate cost value, input value, namely the materials involved in the production process, including raw materials and auxiliary materials. The income formula using the production approach is as follows. You can see in the below. Y is national income. P first is the price of the first item. Q first type of item. P N price of the end good. Q N item type. Second, income approach method. The income approach adds up the income from various production factors that contribute to the production process. All income received by the owners of factor of production during one period is added up to become national income. The production factor include labor, capital, land, and expertise or entrepreneurship. The formula for calculating the income approach is as follows. You can see in below there is formula. Y is national income. R income from wages, salary, etc. W net income from rent. I income from interest. P income from the profit of the company or individual business. Third, expenditure approach method. This approach is carried out by adding up all expenditure in various sectors of the economy, including household, government, companies, and various community. Types of expenditure for each economy actor vary. Consumption expenditure, investment expenditure, government expenditure, and export and import expenditure. The following expenditure approach formula you can see in below. There is formula to calculate it. Y is national income. C household consumption. I investment. G government expenditure. X export and import.
The nature of the national income calculation. 1. Production approach, the sum of the added value of every good and service produced. 2. The income approach, calculate the amount of income received by the owners of the factor production. 3. Expenditure approach. Calculate national income from the total expenditure of all economic actors. The benefit of calculating the national income. Knowing the level of prosperity of a country and evaluating the performance of the country on a certain scale. Measure change in the economy over time and comparing economic performance between sectors. As an indicator of the quality of life of country, comparison of economic performance between country and the quality of living standard. As a measure and comparison of economic growth over time and wealth between countries.
Next, definition of GDP and GNP. First, GDP, or gross domestic product, is the market value of all final goods and services produced within a country in a given period of time. And then the second one is GNP, or gross national product, is the value of products, both goods and services produced by the population of a country or a national for 1 year, including those produced by such citizens abroad. And then besides that, do you know other concept of national income? Yes, the national income including by NNP or net national product, NNI net national income, PI personal income, and then DI disposable income. First, NNP or net national product. NNP is national income which is seen only from the profits earned because the purpose of NNP is to find the net value of a production. Next, NNI or net national income. NNI is national income by total of remuneration accepted by society as the owner of the factors of production. And then the third is PI or personal income. The concept of personal income is the total income that received by each person. And then the last one is DI. DI or disposable income. The concept of DI is income that ready for utilized for buying goods or service and savings that are channeled into investment. Next, how about the mathematics calculation? First, NNP. NNP is equal to GNP minus depreciation. And the second one is NNI. NNI is equal to NNP minus indirect taxes plus subsidy. And then the third is PI. PI is equal to NNI plus transfer payment minus retained earning plus insurance payment plus social guarantee payment plus corporate tax. And then the last one is DI. DI is equal to PI minus direct tax.
GDP, real and nominal. Real GDP. Real GDP uses constant base prices to value the economy's production of goods and services. Because it is not affected by change in price, change in real GDP reflect only change in the amounts being produced. Nominal GDP. Nominal GDP uses current prices to place a value on the economy's production of goods and services. The calculation is affected by an increase in the quantity and price of goods or services produced. This table shows how to calculate real GDP and nominal GDP.
GDP price deflator, as written on the video. Simply put, the GDP price deflator shows how much a change in GDP relies on changes in the price level. It expresses the extent of price level changes or inflation within the economy by tracking the price paid by business, the government, and the consumers. Example: in reality, the economy only grew by 10% from year 1 to year 2 when considering the impact of inflation. So in the example above, the nominal GDP for year 2 would be $12 million, while real GDP would be $11 million. That's the benefit. This is important because, as we saw in our previous example, comparing GDP from two different years can give a deceptive result if there's a change in the price level between the 2 years.
Next material is calculating per capita. Calculating per capita is entailed taking into account a measurement or number amount by which you will then divide by the total population of the group wishing to be analyzed. The following formula can be used to determine the per capita. Per capita is measurement or number of people in a population. Take the following steps to calculate the per capita of a particular situation. 1. Determine the number that correlation with what are you trying to calculate. For example, if you want to know how many people have blue hair per every X amount of people a certain population, you would first determine the total number of people with blue hair in that population. 2. Determine how many people are in that population that you want to measure. This number will be the total amount of individuals in the group you are measuring. For example, if you want to measure how many people have blue hair in your neighborhood, you would need to find out the total number of people who live in your neighborhood. 3. Divide the measurement by the total number of people in the population. So, if there are 4 people who have blue hair in a neighborhood of 250 people, this would give you the following formula. 4 strip 250 sama dengan 0.016. For smaller measurement, multiply the total by 100,000. So, using the above example, you would take 0.016 and multiply it by 100,000. This would give you 1,600. As a result, you could say that 1,600 people have blue hair per every 100,000 people in your neighborhood. Using the above example, the conclusion would be that there are 1,600 individuals with blue hair per 100,000 in the population that was measured.
Okay, next topic is Indonesian economic classification. According to the International Standard Industrial Classification or ISIC, the Indonesian economy is grouped into 3 sectors. The first is the primary sector, the second is the secondary sector, and the third is the tertiary sector. Let's discuss about these each sectors together. The first is the primary sector. Covers the basic needs of the Indonesian people in general, namely clothing, food, and shelters. This sector consists of agriculture, livestock, forestry, fisheries, and mining and quarrying. The secondary sector. The secondary sector is a sector that still contains human needs in everyday life, even though it is not a basic need. This sector consists of processing industry, electricity, water, and gas. The tertiary sector is a sector that contains things that are not basic necessities and can even be categorized as luxuries in everyday life. The sector consists of trade, hotels, restaurants, transportation, telecommunication, and the other services. that's all about our presentation. Thank you for your attention. Thank you for watching and bye-bye.